Here's what nobody tells you about investing in your 30s and 40s. You're told to diversify your portfolio, but most people only know about stocks, bonds, and maybe some GICs. There's actually a fourth option that most Canadians have never heard of. Mortgage investment corporations let you invest in real estate without buying property. They're designed specifically for the Canadian market. If you're juggling a mortgage renewal or savings for your kids' education, Mix can fill a missing gap in your portfolio. But before you jump in, let's see how Mix really stack up against banks, stocks, and direct real estate. Most people think investing in real estate means buying a house, but there's a way to invest in mortgages without owning property. You can actually make money from real estate loans without dealing with tenants, repairs, or property management. This happens through something called a mortgage investment corporation. A MIC is a corporation that pools investor money and lends out as mortgages to borrowers who can't get bank loans. You put your money into a big pot with other investors. The MIC lends that pooled money to borrowers who need mortgages. These borrowers pay interest on their loans, and the MIC distributes that interest to you and other investors as dividends. MICs operate under Section 130.1 of the Income Tax Act, which requires at least 20 shareholders and prevents any single person from owning more than 25% of the company. These rules keep MICs focused on mortgage lending instead of becoming personal investment vehicles for wealthy individuals. The borrowers who go to MICs are different from regular bank customers. Banks have strict lending rules about credit scores, income verifications, and debt ratios. Because MICs lend to self-employed or lower score borrowers at fast turnaround, they charge higher rates, and that extra yield goes to you. Banks might charge 5% interest on a mortgage. MICs often charge between 6 to 12% for these higher risk borrowers. The extra interest compensates for the additional risk of lending to borrowers that banks reject. The MIC normally collects the interest-only portion of the loan. The process works like a cycle. Borrowers pay their monthly mortgage payments to the MIC. It keeps the portion to cover operating costs and management fees. The remaining money gets distributed to shareholders. Most MICs pay these distributions monthly or quarterly. MICs typically focus on specific types of properties. Some lend primarily on residential properties like single-family homes, condos, or small apartment buildings. Others focus on commercial properties like office buildings, retail spaces, and industrial facilities. Many MICs do a mix of both residential and commercial lending to spread their risk across different property classes. The geographic focus varies too. Some MICs only lend in major cities like Toronto or Vancouver. Others focus on secondary markets or rural areas. Some cover entire provinces or even operate across Canada. The location affects the risk and return profile because real estate markets perform differently in various regions. Unlike owning rental property, you don't deal with maintenance issues, tenant problems, or property taxes. You don't need to worry about vacancy rates or finding good tenants. The MIC handles all the lending decisions, paperwork, and collection activities. Your involvement is limited to deciding how much to invest and receiving your distributions. This structure creates opportunities for consistent income from real estate without the headaches of property ownership. The monthly or quarterly payments can provide steady cash flow. But what does this actually mean for your bank account each month? Let me break down the actual dollar amounts you'll receive each month. Most MICs target 6 to 12% annual returns net of fees. These returns get paid to you as monthly or quarterly dividends. The payment schedule depends on the specific MIC you choose. Most investors prefer monthly payments because it provides steady cash flow. Returns vary significantly between different MICs. The variation depends on their risk profile and loan portfolio. MICs that lend to riskier borrowers charge higher interest rates. Higher interest rates mean higher potential returns for investors. MIC that focuses on safer loans offer lower but more stable returns. Some MICs target even higher returns. Returns of 12% are possible with certain MICs. That same $10,000 would generate $100 per month at 12% annually. Remember that higher returns usually mean higher risk. The borrowers pay these higher interest rates might have credit issues or other risk factors. Compare these numbers to other investments available today. A Scotia GIC account currently offers around 3.25% annual returns, and your money is locked up for 5 years. That means $10,000 in a GIC generates $33 to $42 a month. Government bonds offer similar returns. Corporate bonds might pay slightly more but rarely exceed 6%. Bank stocks typically yield about 4 to 6%, while utility stocks may offer 5 to 7%. However, dividend stock prices fluctuate. Your principal investment goes up and down with the stock market. MIC investments typically maintain stable principal values. The tax treatment affects your actual returns. MIC dividend gets taxed as interest income under the Income Tax Act. This means you pay tax at your regular income tax rate. You don't get the preferential tax treatment that eligible dividends receive. Be sure to speak to your accountant for your specific situation, as MIC interest income taxation can reduce your effective returns. Several factors influence these dividend amounts. The specific MIC's investment strategy matters. MICs focused on residential mortgages might offer different returns than commercial mortgage ones. Geographic location affects return too. MICs lending in Toronto and Vancouver might have different risk profiles than those in smaller cities. Economic conditions impact dividend payments. Rising interest rates might increase returns. Falling rates could reduce them. Economic downturns might increase default rates and reduce dividends. Payment consistency vary between MICs. Some have paid dividends consistently for years. Others might skip payments during difficult periods. These returns sound attractive compared to GIC and bonds. The monthly cash flow appeals to many investors. However, attractive dividend yields don't tell the whole story about MIC quality. You need to ask the right questions to separate professional operators from risky ventures. Most people invest in MICs without doing this research, then wonder why the returns disappoint. They see attractive dividend yields and assume all MICs operate the same way. This mistake costs investors money and creates unnecessary stress when problems arrive. Good MIC operators welcome tough questions. Poor operators get uncomfortable and provide vague answers. Many MIC providers avoid discussing their loan-to-value ratios and default rates. They focus on potential returns instead of risk management. This avoidance should raise immediate red flags for any investor. Start with loan-to-value ratios. Ask what percentage of property value they lend against. Conservative MICs typically cap LTVs at 60% to 75% of property value. This means if a property is worth $100,000, they might lend $60,000 to $75,000. Some MICs allow higher ratios up to 85%, but these higher caps increase risk significantly. Higher ratios leave little safety margins if property values drop. Ask how they handle defaults when borrowers stop paying. What happens to your dividend during default situations? How long does foreclosure take? What costs are involved? Good MICs have clear procedures and sufficient cash reserves to handle problem loans. They can continue paying dividends even when some borrowers default. Management fees eat into your returns. Research shows managers often charge 0.5 to 1.5% of assets under management plus origination fees. These fees cover sourcing investment opportunities, analyzing mortgage applications, negotiating interest rates, and general administration. Some also charge origination fees based on each mortgage investment or servicing fees for managing payments. Managers may receive portion of fees paid directly by borrowers, such as commitment and renewal fees. Ask for a complete breakdown of all fees before investing. Track record matters more than recent performance. Ask for 5-year historical returns, not just recent performance during good times. Market conditions change. Interest rates rise and fall. Economic downturns happen. You want to see how to MIC perform during different market cycles. Demand to see portfolio composition and geographic distribution of loans. Where are the properties located? What types of properties do they finance? How many loans are residential versus commercial? Geographic concentration creates risk if local markets struggle. Ask about borrower profiles. What credit scores do they accept? What income verifications do they require? Construction loans carry more risk than loans on completed buildings. Financial statement audits provide important protection. MICs are required to have their annual financial statements audited by an independent accounting firm because MICs comply with Section 130.1 of the Income Tax Act. They avoid corporate tax and pass 100% of net income to investors as dividends. The audited financials ensure accuracy and reliability of financial information. Ask about dividend sustainability during market downturns. What happens to payments if defaults increase? Does the MIC have cash reserves? Can they maintain distributions during difficult periods? Some MICs cut dividends immediately when problems arise. Others maintain payments from reserves while working through issues. These questions help protect your investments and set proper expectations. Once you know what to ask, the next practical consideration becomes how much money you actually need to get started. Public MICs trade like stocks with sub-$20 share prices, while private MICs often start at $5,000 to $50,000 minimums. This difference affects who can invest and how much money you need upfront. The two categories operate under different rules and serve different investor groups. Publicly traded MICs work like regular stocks. You can buy through any broker. The minimum investment equals the share price times the number of shares you want. Many public MIC shares trade under $20 each. This means you could start with less than $1,000. Private MIC require direct investment through the company. You cannot buy these through your regular broker. However, investment limits may vary based on investor status. Investors should read the offering memorandum. Eligible investors have different investment limits compared to non-eligible investors, while accredited investors may have no investment limits. This is set up to protect the investors themselves. Lower minimums usually mean lower returns. Higher minimums often come with better terms. Public MICs trade on exchanges. Their prices move up and down based on market conditions. Returns might be lower, but you get liquidity. Private MICs often target higher returns. They can focus on specific strategies without worrying about daily price movements. Private MICs typically offer better dividend yields. They avoid the costs of being publicly traded. They can put more money to work instead of paying exchange fees and regulatory costs. However, you need more money to get started. The trade-off becomes clear when you compare options. Public MICs give you easy access to low minimums. You can start small and add money over time. Private MICs require large commitments but might offer better returns. The choice depends on how much money you have available. Accredited investor status changes everything for private MICs. Accredited investors are people with high income or net worth. They get access to investments not available to regular investors. Many private MICs offer better terms for accredited investors. They might have lower minimums or higher return targets. Some structure their offerings in tiers. Different investment amounts unlock different benefits. Higher minimums might get you better dividend rates or preferred treatment. Lower minimums might limit your potential returns. The minimum investments is just the entry point. Most successful MIC investors add money over time. Starting small with a public MIC lets you test the waters. You can learn how the investment works before committing larger amounts. Knowing the minimum is just a start. The real question becomes what happens when you need that money back. MIC providers love to talk about returns, but they're much quieter about what happens when you need your money back. They show you attractive dividend yields and paint pictures of steady monthly income. What they don't emphasize is how long it takes to get your money back. The major difference in liquidity between public and private MICs affect everything about your investment experience. Private MICs operate more like closed investment funds. The difference determines how fast you can access your money. Public MICs offer next-day liquidity like stocks, but private MICs can lock up your money for months or years. You can sell public MIC shares through any broker during market hours. The money hits your account in 2 business days, just like selling bank stocks or mutual funds. Private MICs work completely different. Your money gets tied up in long-term commitments. Many private MICs require 30 to 90-day notice periods before you can withdraw funds after the term has expired. These notice periods give the MIC time to manage their mortgage portfolio and ensure they have sufficient funds to meet your withdrawal request. Private MICs handle withdrawal requests through formal redemption policies. They need advance notice because their money is tied up in mortgage loans. Unlike stocks that can trade freely, MICs need time to collect payments from borrowers or find new investors to replace departing ones. The notice periods protect the MICs from sudden cash shortages that could hurt all investors. These redemption policies exist because mortgage investments are not liquid. When someone wants to withdraw money, the MIC needs to either collect payments from existing borrowers or find new money to replace the departing investor. This process takes time and careful management. Without notice periods, too many simultaneous withdrawals could force to sell mortgages at a discounted rate. During periods of market stress, private mix may impose additional liquidity restrictions to protect the fund's stability and prevent runs on the fund. They can delay or limit withdrawals to maintain the mix's financial health during difficult times. However, they also mean your money could be locked up longer than expected. Private mix often pay higher returns partly because your money is less accessible. The liquidity premium compensates investors for giving up easy access to their funds. Public mix typically offer lower returns because they provide the convenience of daily liquidity. The trade-off between return and liquidity affects which type of mix makes sense for your situation. You should carefully review the redemption policies before investing in any mix. Look for notice periods, withdrawal restrictions, and potential fees and early redemptions. Some mix charge penalties for withdrawal within certain timeframes. Others limit how much you can withdraw at any given period. Understanding these liquidity constraints helps you evaluate whether mix makes sense compared to your other investment options. Now, let's see how mix compare to your other investment choices. That money into stocks, bonds, or even more real estate, so why choose mix? The question matters because you have limited investment dollars. Every dollar in a mix is a dollar not invested somewhere else. You need to understand what you gain and what you give up. Mix compete against several common investment options. You might consider buying another rental property. You could invest in dividend stocks or growth stocks. Bonds or GICs offer safety. Mutual funds provide professional management. Mix offer middle ground between safe GICs and volatile stocks, but with unique trade-offs. GICs guarantee your principal but pay lower interest. Stocks offer growth potential, but your money goes up and down with markets. Mix sit between these extremes. They target higher returns than GICs but offer more stability than stocks. Direct real estate ownership requires hands-on involvement. You deal with tenant calls at midnight, you pay for repairs and maintenance. You handle vacancy periods when units sit empty. You manage property taxes and insurance. You screen tenants and chase late rent payments, or you pay for expensive property management services. Mix eliminate all these headaches while still providing mortgage-backed returns. You invest in real estate without touching a wrench or dealing with problematic occupants. However, you give up control with Mix. Property owners can renovate to increase value. They can choose tenants carefully. They can decide when to sell. Mix investors accept whatever decisions the management team makes. You cannot control which mortgages they fund or how they handle problem loans. Stock market investments work differently. Stocks can double or triple during bull markets. Mix rarely see this type of growth. Stock dividends might start low but can grow over time as companies increase profits. Mix dividends stay more consistent but do not grow much. Stock offer potential for capital appreciation when you sell. Mix share prices stay relatively stable. During market downturns, stock can lose their value. Mix value typically remains more stable because they are backed by real estate mortgages. However, this stability means you missed out on big gains that stock markets can provide during good times. Mix work as a fixed income alternative with higher yields than bonds or GICs. Current government bond yields around 2 to 3%. Corporate bonds reach about 6%. Mix often target 6 to 12% returns. This extra yield comes with extra risk. Bonds backed by government are safer than mortgage backed by real estate. The risk-return spectrum shows where different investments fit. GICs and government bonds sit at low risk and low return. Stocks occupy high risks and high return. Mix fits somewhere in the middle. They carry more risk than guaranteed investments but less risk than growth stocks. The returns match this middle position. Your specific situation determines whether Mix makes sense. If you need guaranteed principal, stick with GICs. If you want maximum growth potential, choose stocks. If you want steady income with moderate risk, Mix might fit. Your age, income needs, and risk tolerance all matter. Many advisors commonly suggest allocating a portion of portfolio to alternative investments like Mix. This allocation provides exposure without concentrating too much risk in one area. Some investors use higher allocations if they prefer income over growth. Others use lower allocations and focus more on stocks and long-term wealth building. Mix might replace part of your bond allocation rather than your stock allocation. They offer higher income than bonds with acceptable additional risk. The positioning makes them attractive for investors who want more income from their portfolio. Now you need to decide whether this investment approach fits your specific financial situation. Finally, MICs offer steady income potential with tax flow-through benefits, but they come with liquidity restrictions and credit risks that require careful evaluation. Your personal situation determines whether they make sense for your portfolio. Assess your liquidity needs, risk tolerance, minimum investment capacity, and current portfolio before making any decisions. Consider how much money you need accessible quickly. Think about your income requirements and timeline. Review your existing investments to see where MICs might fit. Ask the right due diligent questions about loan-to-value ratios, management fees, and track records. You now have the knowledge to evaluate MICs properly and protect your investment. If you want to learn how to save money without sacrificing quality of life, watch my next video here. Thanks for watching.